how do I find a company to invest in? What's good? What's bad? And that's what we're going to be looking at today. So, welcome back to My Money Mentor. I'm Andrew, and I'm so glad to see you guys again today. So, in today's episode, you, Winston, and myself are going to be looking at trying to find a stock that we can pick for our next purchase for our Invest With Me segment. So, come along for the journey and let's have a look what we can find. First things first, you want to do a bit of research into what kind of company you want to buy. And how do we do this? If we're a beginner, it can be a bit daunting and you might not really understand how to do it. So the best thing to do is just to Google it. Realistically, all you need to do is chuck into Google, how do I research stocks? And it'll come straight up. You'll find a few hints on how you can do it, which I've done right here. So let's have a look together. The top pick that's come up is from CommSec, which is a pretty reliable company. It's one of the top 4 major banks in Australia, so quite reliable. And they give you a little bit of a rundown of what you can do. So you're going to look at what the company does and how it generates its revenue. So is it going to be something in finance like a bank? Is it going to be in mining? Is it going to be in technology like AI, or just computers, different microchips, whatever? Is it going to be an automotive company or flight transport? You know, what kind of sector is it in and what does it do to make its money? The next part is checking out its financials. So actually making sure that it's earning money. Not every company does. You do have growth companies that do keep putting a lot of money, and also trying to take some debt so they can try and leverage as much as they can, grow their company as fast as they can. Next one, using price charts to spot trends. Generally, what I like to try and do is invest for long term. Over time, statistically, it is the most proven way to make money. And if you look at, for example, the S&P 500, the ASX 200, any other, market that you want to look at, since 100 years ago, since its very inception till now, it's just gone on an absolute wild bull run. And yes, you do have bad times, like you do have the GFC, you do have this war going on with Iran at the moment, and it's not looking great with the cost of oil and everything, but realistically, there's only so long that'll go on for, and at some point, everything's going to go back to normal. The only real way that the market will completely stop dead in its tracks and go to zero is if there is a major calamity, like nuclear winter or something like that, because we've just fired nukes all over the world. Let's hope that doesn't happen, but at that point, really, is cash going to do you any good anyway? So there's that. So the next one is monitoring your stock. So just keeping an eye on it every now and then. You don't need to be staring at it every day. And generally speaking, I really try not to. I really try and pull myself back, keep my eyes off the stock. You don't want to get so emotionally attached to your stocks that you're worrying about it all the time, freaking out like, oh my God, it's gone up $10 today. It's not going to make you rich overnight, okay? And just being that emotionally invested in it is not healthy. You need to kind of detach yourself from your stocks and think of it more purely on the finance side rather than, just emotionally connecting to them and saying, I own them, so they have to go up. That's pretty much it. Looking beyond the numbers. So this is more about narrative. Where do you feel like it is going to go? Like if you look at Bitcoin, okay, the numbers are saying it started at $10, then it went to 1,000, then 10,000, now it's at 100,000. So, it looks like it's going up and up, but what happens if there is a crash? Like right now, it's gone from, I think it was at 100 and something thousand Australian dollars, 130, 40 something thousand Australian dollars. And now it's come all the way back down to 100,000 Australian dollars. That doesn't mean it's going to end. The narrative behind it is that it could be the world's next currency. It has a finite supply and no one can manipulate it. There's a few different things behind it that make it special. For our company that we're going to look at today, so we're going to try and find something that matches one of these criteria. Does the company have a competitive advantage within its industry? Is it easy or is it difficult for competitors to enter the market? Are there any events or economic conditions that could impact the company? Just quickly, an example of this one, let's say Qantas, for example, if it's an airline, COVID shut it down, the Iran war is making it difficult with flight paths and stuff. So airlines are definitely dependent on what's happening in the world. So you need to be aware of that, especially if this World War III breaks out, like could be a risky investment. But, you know, if everything all goes smoothly and everything, it's a pretty large, stable company. They've been bailed out before. The Australian government wants to protect it because it is a flying kangaroo and it is kind of a mascot for Australia. Next one, does it provide a product or a service that can be easily substituted for another? This one is tricky. So if you look at iPhones, for example, they've got a massive market control on a whole bunch of people because everyone's thinking, yep, I love the iPhone. I've got the iPhone 10, 11, 12, 13, 14, and you know, I don't know why everyone keeps buying the newest phone and spending an absolute fortune. There's not really that much difference between that and the generation before it. But anyways, you know, everyone can spend their money how they want. But it's not necessarily what's in the phone, more the software, right? So they make it so user-friendly and so easy to use that trying to change to an Android might actually be a little bit more complicated and uncomfortable because it functions a little bit differently. I myself changed to a Google Pixel. I like it. I think it's a good enough phone. It's definitely cheaper than an iPhone. And I buy one that's a couple generations old, so I save a bit of money there. Was it awkward changing from iPhone to Google? Yep, absolutely. Does it affect me now? No, I'm so used to it, so it doesn't bother me. So I guess that's where that's coming from, you know, like you can substitute an iPhone for a Google Pixel, but would you, because you already have that customer base that's comfortable with using that specific product? Next one is, do companies' customers or suppliers have a lot of power over its prices? So can they be manipulated either by the customer or by the supplier? Let's say you have Woolworths, for example. If customers aren't going to Woolworths because Coles has cheaper products, or if you're American, let's say Walmart, if people aren't going to Walmart because Costco has better prices, then, you know, Walmart's going to suffer because of the customers. On the supplier side, if farmers are selling to a different company, so we've got Woolworths that farmers supply to, if Audi is going to be giving them a better price, they're going to be giving them more for a liter of milk or a dozen eggs, then the farmers are going to be going over to that other company as well. So there are some companies that can be manipulated depending on what's going on. And next one, seeing what the experts have to say. So sometimes you do get companies like ComSec that go through and just analyze a little bit what's going on with the company. You've got Morningstar that will give you a bit of a rundown what they think is a good stock to pick. Do I really trust them? No. You know, you do have a lot of experienced people out there. Would I trust someone else with my money? Absolutely not. Just like I don't think anyone watching my videos should trust anything I say when I'm actually purchasing one of my investments, because even though I may believe that one of my purchases is fantastic, it could go to zero in the next day. So that's why I've always got my disclaimer that says, do not do what I say, you know, go see a proper financial advisor to get advice suited for you, which should be with every investment. So let's log into ComSec quickly just so we can do a screener. All right, so now that we're logged in, what we're going to be doing is going over to Quotes and Research. So once we've clicked on Quotes and Research, we've clicked on Recommendations. will be in this tab right here, recommendations. You can go to your stock screener, which is a fantastic way to find a company that you want to look for. And I can just show that really quickly, although I have done that previously. So you could look for a criteria, say market cap within the top 200 companies. It may give it minimum dividend yield, and maybe have a certain price to earnings ratio as an example. Once we've got that, we can click, say, large cap. I always find it's a better idea to stick with large cap companies. It just gives you a little bit of wiggle room because you're working with a bigger company rather than with something that's still young and a bit risky and volatile. Say minimum percent dividend yield, say 3.9%. Price to earnings ratio, we want to keep it, say, under 23, let's say, as an example, and in the top 200 companies. Top company that comes up, Woodside Energy. So that's one that we actually purchased in our last Invest With Me. And since we've purchased it, it has gone up, I think, for $3 so far, which is pretty good. But we've got a few other companies. So Suncorp's one that I've seen around before. If we have a quick look at it, we click on our chart here, 10-year. So seems like it has its highs and lows. It's pretty on par in the middle at the moment. It's got a couple ratings. So December last year had a $16 fair value rating. Start of this year, $20. So it's saying it's slightly undervalued. Dividend yield is 4.6%. So that's a nice little dividend company. And the stability of it is 93%. So 93% of the time, roughly, they're going to actually pay out the dividends without just cutting it or whatever. Franking 100%. So franking basically means you've got credit towards paying off the taxes on your dividends. So you're covered for that, which is fantastic. This actually looks like a decent company that we could look at. If I go back to find and filter stocks, we've lost our criteria. That's all right. So I guess when you go from looking at a company back into your find and filter, you'll need to input your criteria. What I recommend when you're doing this is just grabbing yourself a book, jotting down the companies that you find in your book, and then one by one you can have a look through them and see what suits you. And it doesn't matter if you pick 20 companies out of it, because you can always just, have a look. If you don't like something about a company, whether it's the products they sell or, their finances or whatever, then just can it. Don't worry about it. In this recommendation section, like I've said before, I don't super like looking at the recommendations of what these ratings agencies say. I don't 100% trust them, and I'd rather just make my own mistakes, essentially. So if I make a mistake, I'm not too fussed. What I'm going to do here, though, is I've clicked on large market cap, strong buy recommendations, and you can change other bits and bobs to see what pops up and see what there is. So far here, so we've got Zero, which is a tech company, which I've actually been quite interested in. Let's see if I click that. That won't give it to us. So I've clicked a detailed quote, and now that we can have a bit of a better look at the company. So they've had pretty good run-ups, had a bit of a drawback, bit of a run-up, bit of a drawback. Kind of seems like a bit of a trend, like it's a volatile company. Interesting. So this whole 2021, 2022, that's sort of the period where COVID had shaken up the market a bit, but that's coming out of COVID from memory, because you had COVID 2019, 2021, 2022 was sort of ending. So I guess once COVID had passed, it sort of picks back up in 2023 again. Now we've got the issues happening in Iran, the war and everything, so it's dropping away again. That's just volatility, I guess. So I wouldn't be too concerned that it's going down, and that could actually just be an opportunity to buy. Recommendations on it with fair value targets around $100. There's 10 strong buys on it, 3 moderate buys and a hold. So a few different recommendations there saying it's a decent buy. You'll notice on this one there's no dividend yield. So I'm not fussed if a company doesn't have a dividend yield. I'm still young, so I'm looking for growth and, just a company investing their money again into themselves wisely. The one thing that throws me off here is that it's got a huge PE ratio. That, although, could be offset because they may be reinvesting or just taking out debt so that they can try and grow their company larger. It's not uncommon to see companies go into quite a high PE ratio because they're focusing more on spending to grow the company rather than to save every single dollar and give it back to investors. If we go back, we've got Qantas here. I always like Qantas. Let's have a look here. So 11 strong buyers, 2 moderate buyers, 2 holds. The thing with Qantas is how long are we going to be struggling with oil? Is Qantas going to cop a huge hit because oil is so high at the moment? So potentially it could be a good time to buy if we have a look here at detailed quote, because I know that they have dropped in recent times from around $12 at their peak. They've dropped quite a bit, but they're still higher from where they were in the last few years. So there is still potential for it to come back to around the tops of these ranges, which is $6. That is more technical analysis based. Generally speaking, Qantas in the long term, it's a good company. It's got backing from the Australian government, and it'll do well in the long term. I'm just saying if perhaps I may be able to get in at a better entry price. If we change this back to all, let's have a look what we've got going on. A2 Milk. So A2 Milk makes milk and baby formulas and other bits and bobs, which is strictly the A2 protein. With that one, although it says moderate buy, so my research that I like to do is seeing what actual consumers use. So I've spoken to different people, including mums, because a large portion of it is baby formula. And a lot of them say it's too expensive for what you're getting, and they tend to go with different brands. So I may just stay off that one just for the moment and see what happens down the track. Cochlear, let's have a look at that one, because that's a company that was doing really well in the past. And clearly you can see they're not doing well in present times. So they had a huge run up to about $350 up the top, and now they've dropped quite far down. So what you need to be careful with a company like this is when you see the price falling and falling and falling, there's no definite answer of this is where it's going to stop. So I might buy it here. It might keep going to $100 or $50. You don't know. There are ratings saying that it's undervalued and to buy, and the price will go higher. Their PE ratio is 27. They are offering a dividend, so they are an established company, and they offer, like, I believe, hearing aids and stuff, different implants. But even though they're an established company offering a yield, I still think that they do have room to grow going into the future as well. perhaps maybe I would just hold off for the moment. This might have just been all blown a bit out of proportion, and I might just wait a minute longer on that one. So the reason why I'm talking through all of this quite casually is because I believe that you knowing what's going through my mind when I'm investing gives you the best, groundwork for yourself for the future to actually go about this research yourself. So you can kind of talk to yourself, not because you're crazy or anything, but because you just want to talk through each company and see what will actually suit you the best, and actually be worth your money at the end of the day. There was one company in particular that I was looking at. So let's see if we can get a grip on it. So here comes Qantas again, strong buy with 11 strong buys sitting behind it. So a few rating companies must like it. What if I go up the top here and I change current rating to strong buy? Here we go. Let's have a look from the top down. So Aristocrat, so gaming company, gambling, gaming I'm talking about, is right up there. 10 years, so that's had a pretty decent drop. Now, what you need to know is, down here, if I draw a line from the bottom here coming all the way up, it will touch a point there, touch a point there, and it will probably touch a point here. That's called a trend, and generally speaking, it gives you a rough guideline of where you can expect the price to go in the future. So if it's touching a point around here, it's pretty well around the bottom, statistically speaking, right? It can very definitely keep dropping, but it can also definitely turn around. And it's sort of like a resistance point where people say, that's an interesting price. I feel like my risk isn't too high, and I feel like I can make a good return on this. So I'll buy at this point here. And that's where it kind of turns it around and takes it back up. It offers a small dividend of 2.1%. It's pretty stable, the dividends. P/E ratio of 22, that's not too bad. So not bad, not great sort of thing. Let's see where it's gone. So over the past 10 years, so $11 to $46. That's a phenomenal return. If I invested over a 10-year period, I would roughly want my money to double. Okay. If it does a bit more than double, amazing. I love it. If it does, say 80% rather than 100%, so it almost doubles, that's still fine, because it's you're expecting to double your money on average every 10 years, right? And that's the goal. That's a golden standard. If you can double your money every 10 years, you're doing a fantastic job. So this company from 10 years ago, having almost, 5 times their money, they're 4.5 times their money, basically. That's phenomenal. If we keep looking down, there was one in particular that I was keen on. Let's see if we can find that. Here we go. So Pro Medicus, this is one that I was in particularly keen on. So it's got a moderate buy here. So it says 9 strong buys, 1 moderate buy, 3 holds, and 1 strong sell. So there's one person that is convinced Pro Medicus won't do too well. This company is a imaging company for x-rays and other like medical scans. They sell to hospitals and all of that. Now, like I was talking about in my previous video about how it's difficult for consumers to move from one platform to the next. Let's say for someone to go from Apple to Samsung, it's awkward. They don't like it. It might be a different interface, or just the user experience is a bit clunky compared to what they're used to on Apple. It's just unfamiliar. So it can be requiring a bit of transition period, which they don't like necessarily. So they might just stick with iPhone in particular. If you have a company like Pro Medicus that offers a specific type of imaging and whatnot, And now I believe they're also trying to get into AI for all their imaging. Um, it might make it hard to transition, especially for a hospital or a system of hospitals. Where I'm from in New South Wales, we've got New South Wales Health, so it's basically across the entire state. They would pick one particular company that they're going to go with for their imaging as a whole, or for, whatever it is, because then they can basically buy in bulk, save money per unit, like per scan, for example, or whatever it might be. But the problem is, once they're hooked onto one company, it can take a little while to actually transition over, and it will be difficult, and there'll need to be a whole bunch of training done, and it will cost a fortune. So a lot of times companies stick to the one software that they used to, or people stick to the one item that they're used to. If we have a look at this though, over a 10-year period, so it had a huge run up, massive growth in this company, but then it's had a ginormous drive down as well. This one does not have a trend like that last company we were looking at. So this one's basically gone parabolic and then had a huge drop off, and you can't really pick the bottom with this company as well. There's a lot of people saying sell, overvalued, but then you've also got, mind you, that's in 2022. This one's more recent, 2025, but you've still got heaps saying strong buy. So this is why I'm saying be careful with who you look at for their recommendations, because yeah, definitely it could fall to $60. Absolutely. There's nothing saying this company can't go to $60. But then you also have 9 companies saying, well, actually, we think it's the opposite. I would say buy it now, because if it goes back up to that $300 mark or more, then you're making a huge return. And remember, you're hoping to double your money every 10 years, roughly. What's to say this company in 10 years' time is not back at $300? Because it went from, peanuts back when it first started, $6 when it first started. But like, let's say in more recent times, since around COVID times, it went from about $50 up to $300. So that's a 6 times return. That's massive. And it must have been showing some real positive results there for it to actually grow that fast. But coming back down here, it's essentially on sale, and it's not far off of where these points back here were when we were more back down to earth. So if you can imagine a straight growth line from here, it could make sense that around this $100 mark could be what it would be worth today. $300 does not make sense. That's just FOMO. That's everyone buying in and sending it parabolic, and it's not really a great idea to jump into companies like that when they're growing so fast. But now that it's kind of settled down a bit, it could be an opportunity. They have a very small dividend, so 0.5%, which is a good thing in my mind, because it means most of their money is going back into the company. However, they are also open to the idea of a dividend and, giving something back to the investors. I don't know if they offer a dividend reinvesting plan, which might be really nice to be able to just take those dividends, put it back into the company. But the franking credits that you get 100% franking credits, so you won't have to pay any tax on that one. 90% plus dividend stability, which is great. It's got a very high PE ratio of 87.88, which does make me a little bit skeptical and a bit on edge, thinking maybe it's not the right one to buy into right now. But you know what? When you're looking at a company like this, for example, and you're loving it, but you're not too sure about it, right? Let's do some Google and see what else we can find online. So right here, I typed in CEOs buying more stocks on the ASX, and this is first what brought me onto Pro Medicus. In the very first place, I was looking at companies like Pro Medicus, WiseTech, and a couple of these really high valued sort of market darling companies that were really performing well in the last few years that have come back. But when I've done a little bit of a Google, let's see what we found. So what we've found is that we've had insider buys from the Pro Medicus team where they've been buying, like Anthony Hall, one of the directors, has bought a couple $1 million worth of the stock. You've got Sam buying $500,000. Anyone else in the group? No, okay. So you've got pretty much two people that have bought a few $1 million worth of the stock. And looking back at A2 Milk, so you've got one of their directors having sold $4.5 million. So that's a good idea to have a look at to see, okay, well, the people that are actually running these companies, what do they think? Because clearly this person selling $4.5 million, yeah, they may be going to buy a nice house, but on the flip side, they could also just be trying to get out as well. So the facts that we have buys going on with, high rated people within the company gives me a little bit of confidence within the company that they think that they'll be able to turn it around and really grow it quite well. You can also just type in the ticker code or whatever the company is called. So I could have typed in Pro Medicus as well. You'll be able to see a chart, see what it's done over time. Down here, so you've got a few different websites you can have a look at. So Market Index will just give you some of the analytics, give you some of the announcements, and you can go back through and see what there's been. Having a look at the yearly results is a fantastic idea to see what the company's been doing. Having a look at previous dividends to see what they've looked like, and it seems like the franking has been 100% on all of them, which I really like. The growth on this, year after year after year, clearly 2026 hasn't been a good year. Mind you, this could also be, and I wouldn't be surprised, just half of the year before because we haven't been paid the final dividend yet. So when we get around to the later part of this year and we pay the final dividends, you'll see this chart jump all the way up above here. And that's actually quite impressive. From 2015, every year you've seen a growth in dividends being paid, except for this COVID period, which I'm impressed they still paid a dividend during COVID anyways. But after that, just growth, 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 growth. If we go back here, you can have a look on the ASX. You can see a more accurate chart, having a look at different bits and bobs if you want. They just give you more data. Same sort of thing. Morningstar, I believe, is paid for to actually look at these things. But if you're willing to pay for them, here we go. So sign up for a trial access for Morningstar Research. Not interested, I don't need to pay for it, but if you'd like to, it's there. Hot Copper. Hot Copper is basically like a chat forum. Everyone wants to have a little bit of a discussion and see what everyone's opinions are, especially when different topics come out. They add a new part. The quality of information on Hot Copper isn't reliable. I would not trust it whatsoever, and really be careful with what you read on this forum. So take everything with a grain of salt, but yeah. So let's buy our stock. If, for example, like me, you're not 100% convinced about the company, okay, I don't know how much further this could drop. You've got some people that think this company might not be done dropping yet, but even though it's also still got a high PE ratio, you saw that dividend year after year increasing. You've seen that it does have potential to grow, and people are quite keen on this company, and it offers a, where are we? And it offers a good service. So it's healthcare, right? I believe in healthcare, and want to see it grow and develop, and I wouldn't mind my money being invested in something that could potentially help other people. And, you know, at the end of the day, money makes money, but where you put it could still help people. So if we want to buy something, same as last time, we'll smack our buy button, PME units. So if we want to buy an amount, we can put in $500 worth, and that'll get us 4 units of PME. Let's see, how much is a unit? So it's about $117, or they're about $118, let's say. So let's math this out. Say it's 120 times 5, it'll be more like $600. 600 will give us 580. Oh, damn. We're almost there. 590. Actually, let's change this to 118. Okay, so we're happy to spend up to $590. It'll give us 5 stocks at $118 per stock. Good till expiry. And in total, it'll cost us $594. So let's see. What if I make this? And if we hit our review order button, so we'll have a look, limit order, 590. We've got $118 per unit, and we'll get 5 units out of it. It's $5 for the brokerage, and we'll hit submit order. There we go. And now, if we want to place a different order, so we'll go quotes and research, recommendations, a large market cap, and which one did we see that we loved? So recommendation, strong buy. Let's have a look. So wow, 16 strong buys. We might need to have a look at this company here. 10 strong buyers, 11, 12. So there seems to be a few companies that people are interested in here. Aristocrat, that was the gambling company we looked at. But let's have a look up here first. Okay, so seems to be a newer company. If it was established, say, 2023, we haven't got that much data on it to see where it's going to go. I would probably stay out of this one personally, because I don't know what this company's history is, and I would prefer pick a more reliable company. Zero. So Zero is another company similar to ProMedicus, like on the same sort of track. So it's had a big run up, sort of a drop off. You know, from here, I wouldn't be surprised if it found same sort of support around this level and went back up. Let's see, does it offer dividends? It does not offer dividends, which is fine because it's still a growth company. But the other one that I was keen on, that I thought looked really interesting and I wanted to get in on, is Qantas, potentially. So let's have a look. All right, so Qantas over the last 10 years. So it's had a small drop now, but could it come lower? And honestly, I'm going to say it probably will. Just because I believe that the whole Iran situation will last for longer. I don't think it's done. I think oil prices will continue to stay elevated. And not just that, I also think people struggling with the cost of living might spend less. So less holidays, less flights. I was really keen on Qantas before, but now after seeing Aristocrat, I'm actually very keen on this company because that's got a beautiful little trend there and it looks like it's on sale at the moment back down to where the trend line catches it. It's got a small dividend, which is okay. It's almost 90% dividend stability, which is pretty good. But there's no franking, which kind of sucks. So I'm going to have to pay my own taxes on it. Price to earning ratio is 22. So that's okay. In the long term, I wouldn't be surprised if we saw this company keep going up. So we spent about 600 on our Pro Medicus shares, which means we have $400 left to spend. So if we put 400 and we bought these at, let's have a look. So the offer is $46. The bid is $45.70. Let's just split the difference. Mind you, there's a lot of volume on the seller's side. But if we split the difference and we say we buy it at $46 on the dot, or even here it's saying 45.98. Yep, that's fine. I'm happy with that. I wonder if we could maybe squeeze out a little bit more than 8 units. So if I change this to okay, so 420 will get us 9 units. So $413 gets us 9 units, plus we'll pay $4.99 for brokerage, which takes our total to $418. We'll submit our order. Okay, so here's something new. Minimum order of 500. So let's have a look back at this. Let's see if we can get close to an extra share. Oh, look. So sometimes just ticking up an extra $10 will get you an extra share, which is fantastic in my book. We're going to hit review order now. We're going to check it. So $505. So it only took an extra $5.78 to actually get us 1 extra share, which in the long term could be, you know, tens of dollars or maybe even hundreds of dollars difference, you know, when you combine dividends and growth of stock price. Our $5.99 in brokerage takes our total to $5.10. Submit order. And there we go. We've got our order submitted now. So now looking at our orders, We've got Aristocrat and we've got Pro Medicus on order, and we'll see what happens with that. And that's the end of our video. So thank you guys all for joining me for another episode of Invest With Me. I had a really good time. We've got in our 2 new orders and we got to see what our stocks have done so far from last time. Hopefully next month as well, we'll be able to pick another stock or two to invest in. If you have any ideas for what we should pick next, leave it in the comments below. If you're a new viewer, be sure to like and subscribe if you're keen on this content. I'll have plenty more coming out over time. Some will be invest with me and some will be just more of an educational thing as well. So I'll hope to see you next time. See you guys.
The information provided in this video is for educational, informational, and entertainment purposes only, and does not constitute financial, investment, tax, or legal advice. I'm not a licensed financial advisor, tax professional, or attorney. The content is based on personal opinions, experiences, and research, and is not intended as a substitute for professional advice. Investing involves risk, including the potential loss of principal. You're solely responsible for your own financial decisions. Always conduct your own due diligence and consult a qualified professional before making financial decisions.